Hi there, welcome to ET Now. Very good morning. You're watching Market Cafe with me, Kanishka Sarkar and Ankita Saxena. Over the next 1 hour, we'll take you through all the global and domestic cues that you need to keep on your radar today, and also tell you about the stocks that you need to watch out for before the start of D3 today. But before that, let's get started with an eye on the globe. And of course, the top story is the Fed rate cut that has come in. But let's first tell you how the U.S. markets reacted to that. Now, the Wall Street had a choppy session overnight after the Federal Reserve delivered a widely expected quarter-point rate cut. Now, the Dow Jones Industrial Average was the sole gainer among the major averages. Now, that closed up 260 points, or about 0.5%, whereas the S&P 500, that slipped about 0.1%, and the tech-heavy Nasdaq index, that also eased about 0.3%. Now, the Fed move was seen as a risk management, with Chair Jerome Powell signaling caution on the pace of future cuts. The policymakers have projected 2 more cuts this year, but only 1 in 2026, far fewer than what the traders had priced in. For the week so far, however, there's a tone that remains positive. The S&P 500 is up about 0.2%, pacing for its 6th gain in 7 weeks, while the Nasdaq, that is added about 0.5%, on track for its 3rd straight winning week, whereas the Dow, that is higher about 0.2%, which would mark a 2nd consecutive weekly advance. Well, what to watch out for next? Of course, it's the investors. They're now tracking upcoming U.S. economic data and the Fed commentary to gauge how far the rate cut cycle can realistically go.
All right, moving on then, let's take stock of how the crude is faring then. If you look at the crude prices, oil prices have eased on Wednesday. After we did see that data showing an increase in the U.S. diesel stockpiles that has stoked, worries about demand at the U.S. Federal Reserve that cut interest rate as expected. Crude paused the 3-day advance despite, the supply risks. We do see Brent crude settling in at $67.87 a barrel. The WTI settling in at $63.95 a barrel. Now remember, the U.S. crude inventories fell sharply last week with a jump in exports and a sharp decline in the imports. And, the Energy Information Administration said on Wednesday that the rise in the distilled stockpile stoked demand concerns and has kept the oil prices in check, or has kept a lid on the oil prices. So as of now, we do see a Brent settling in at $67 and thereabouts, and WTI around $63.95 a barrel. So that's where the crude is trading at.
That's right. So that's how the U.S. markets have fared overnight, as well as that's how the commodity market is shaping up. But then the Federal Reserve, that has cut interest rates by a 1/4 point on Wednesday, that is yesterday, signaling 2 more reductions may follow this year. Chair Jerome Powell has called the move a risk management cut, reflecting concerns over a cooling labor market and rising inflation pressures. The move, which puts the benchmark rate in a 4 to 4.25% range, came on an 11-1 vote, with the new governor Stephen Moran pushing for a deeper half-point trim. Now, while most policymakers expect just 1 more rate cut in 2026, some see room for 3 as well. Now, Powell has warned that tariffs are beginning to push up goods prices and warned that there is no risk-free path going ahead for the central bank. Let's listen into his comments on what he had to say about this rate cut.
In the labor market, the unemployment rate edged up to 4.3% in August, but remains little changed over the past year at a relatively low level. Payroll job gains have slowed significantly to a pace of just 29,000 per month over the past 3 months. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation. Even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant. In addition, wage growth has continued to moderate while still outpacing inflation. Overall, the marked slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. We think moderate long-term interest rates are something that will result from stable inflation, low and stable inflation, and maximum employment.
All right, that was Fed Chair Jerome Powell speaking about the Fed rate cuts by quarter point yesterday. But Varun Dubey is also joining us with a roundup of all that that Jerome Powell had to say, and what does it really mean? Take it away, Varun.
Definitely. So finally, it's a rate cut in the US markets, and the first rate cut for calendar year 2025, and it's the first rate cut after January 2023. So 25 basis point is the rate cut that has been done, and now the range for Fed is 4% to 4.25%. And the good point is that the overall rate cut votes were actually 11:1. That means majority of the FOMC members have actually voted for a rate cut. It was only one member who was actually Stephen Miran, who actually voted for a more than 25 basis point rate cut. That was a 50 basis point rate cut. That was what he has voted for actually. So majority of the members have actually voted for a rate cut this time, and some are actually expecting more rate cuts. In fact, now the Fed is expecting 2 more rate cuts to happen in calendar year 2025. That means the going on the October and December policy can also see more rate cuts going ahead. And now the medium range, the medium projection for the year end of 2025 comes at around 3.6%, and for 2026 it comes at around 3.4%, and then after that the median range comes at around 3.1% for 2027. So you might see more rate cuts going ahead. Also, on the labor market condition, he has said that yes, the labor market conditions are softening, but they are not that bad. On inflation, the Fed is projecting the inflation is expected to be around 3% in 2025, falling to around 2.6% in 2026, and also 2.1%, then to 2.1% in 2027. So this means the overall inflation is expected to be to some extent on an elevated level going forward as well. Also, if you look why the US markets actually fell after the overall rate cut decision, one is because the US markets were already at life high and they were expecting a 25 basis point rate cut in the Fed policy, and that's the reason you have seen some profit booking. Other than that, if you look at the overall commentary of Fed chairman, it was more of a risk management rather than improving the economy, and that's other reason why the US markets actually fell after the rate cuts. So yes, the much awaited rate cut has happened, the first after January 2023 and the first in calendar year 2025, and you might see more rate cuts going ahead. So rate cut cycle for US markets have actually started now.
That's right. The rate cut cycle has started, and the key commentary that we're tracking is, of course, that it's a risk management cut. Thanks, Varun, for taking us through that entire roundup. But to discuss this further and what's going to be the impact on the U.S. economy and across the world, we're now joined by Andrew Ferris, who's the CEO at Economist Advisory. Hi, Andrew. Thank you so much for joining us this morning. Well, is it like an I told you so moment? You've long been skeptic of the market's expectation for these aggressive rate cuts. Now that this more measured move has come, does this outcome validate your cautious stance, and how are you, altering your long-term outlook for the Fed policy on the back of this move that has come?
Well, there are two things here. Never mind what I think what the Fed should be doing. It is what the Fed itself does. I think this was a very bad idea to cut interest rates at this particular juncture. But as the Fed indicated very, very clearly, it was a very balanced approach, whether they are going to pay much more attention to the labor market rather than to inflation. I am paying much more attention to inflation, and I feel justified on that because the long-term bond yields, the yield curve in the States after the cut hardly moved. The long-term 10 years didn't move at all. They went down and then up and then stayed more or less flat, and the same thing with the 2 years. So the bond markets are telling us that they are not impressed. They don't think that the cut in interest rates is going to be something that's going to be reflected on the longer term side of the market, which is the one which is influenced primarily by inflation. Ta-da! So inflation is very much in the forefront of what the markets are doing. And also the overall behavior of the S&P, I wouldn't say it was extraordinary. So muted reaction, okay, because I suspect the markets, like me, are much more concerned about inflation rather than the labor market.
Right. Hi, Andrew. This is Ankita also joining in. Good morning. And in fact, that was my question to you. With this rate cut coming through, the focus is clearly shifted to the labor market. What about the inflation? Is the Fed not penciling in the inflation that perhaps might ensue as a result of the tariffs? Because sooner or later the costs will get passed on to the consumers, and there will be a heated inflation. And is the Fed not taking account of that?
Well, it is taken, but they decided that the concern over the behavior of the labor market and therefore what is going to happen in the economy is more important. My question, however, is the following. Okay, so now let's pretend that we're going to cut interest rates by 125 basis points. That's the extreme use. I don't think for a moment this is going to happen. How will this affect employment? I'm trying to think, how will this affect employment? By more investment? Well, a much lower decrease in much lower interest rates is going to encourage a lot more investment on artificial intelligence. And this has nothing to do with creating employment. And also, it is what I will call it, a bubble approach to investment in one particular sector where the markets already have got deep suspicions as to what is going to happen with artificial intelligence. So cutting interest rates and keeping your fingers crossed that this is going to affect employment, boy, that's a very, very, very optimistic view. In general, cuts in interest rates take about 9 months to be transformed into some action in the real economy. So we're looking now 3 months plus to Christmas and then 6 months plus to midsummer. So we're looking to midsummer plus if we're going to see any impact on employment, whereas we are still assuming very significant impact on inflation. For the last 7 months, all the inflation numbers have been up, I emphasize that, or flat, not down. So the inflation trend is going up, not down. And a cut in interest rates is not going to discourage it, particularly asset inflation, which unfortunately is not reflected on the CPI.
Andrew, as you mentioned that perhaps this rate cut is not going to augur well. How will it augur well for the labor markets? That is your question. But, the policymaker projections also suggest 2 more rate cuts on the annual, perhaps in the month of October and December. What do you have to say for that?
Well, I'm not sure, in fact, if that makes any sense, given also that their dot policy chart has 6 out of the 12 members saying no change. So I prefer to take this as an indicator of what's going to happen between here and the end of the first quarter, no movements in interest rates. That's what the Fed is telling me, not what I'm telling the Fed or what I think the Fed should do.
That's right. Now, Andrew, like the Fed has been mentioning that the focus is now shifting to the labor market. But like you said, if the interest rates are cut, investments might actually go into AI and may not really help the labor market. So what do you think the strategy should be to, apart from rate cuts, what else can be done? What else should be the strategy to improve the labor market?
Well, you're asking me to advise President Trump as to what does next for the labor market. Oh boy, that's quite a tall order. Of course, I have my views. The tariff policy has been an absolute disaster. Because if you're asking me right now, what is the tariff policy? I have no idea. What's happening with India and the United States? I don't know. What's happening with China and the United States? Well, the last thing we heard was that Trump was encouraging the European Union as well as himself to add more tariffs on China in order to punish it for its support by buying oil from Russia and therefore the Ukraine. It's a complete incoherent mess. That doesn't help at all for investment. Look also what has happened with the investment of South Korea in United States. They arrested about 500 Korean workers and they threw them out. And in fact, when the Korean workers were asked if they want to stay in the States, they all said no. I mean, hardly a big move, but all showing that the Trump administration hasn't a clue as to what to do next, except carry on putting more tariffs, and then they proceed not to. At least if they said, okay, we're going to impose 50% on India, well, do it tomorrow. Ring up Modi and says, for Monday, we are increasing all our tariffs by 50%. It's not happening. I'm not saying it's a good idea. All I'm saying is that if one is asking what can the Trump administration do in order to increase employment, their idea was to use tariffs. Well, they are not even doing that.
All right, Andrew, thank you so much for taking the time out and joining us and weighing in on the FOMC decision. Thank you for joining us then. And now we'll move on to the top headlines for the hour. America's biggest banks moved quickly after the Fed's rate cut. JP Morgan, Citigroup, Wells Fargo and Bank of America all lowered the prime lending rate to 7.25% from an earlier.
We'll take all the action forward.
Spain was progressing well and the benchmark index jumped. It's trading up 0.8%. It has breached, like I mentioned, the 45,000 levels and it has hit a fresh record high. So Nikkei is doing very well. That's up 0.7%. Besides that, we do see Kospi also, that is up 0.7%. So these two indices are trading in the green. But besides that, we have Shanghai that is absolutely flat as of now, trading with a negative bias of 0.03% as of now. And Hang Seng, the Chinese markets basically trading in the red. Hang Seng is down 0.1% and S&P ASX 200 is trading down more than 0.5% right now. So that's how largely the Asia Pacific markets have opened up. As far as Nifty's implied start is concerned, GIFT Nifty is trading with gains of 0.2% or 44 points jump up is what we can see as far as Nifty is concerned.
That's right. Now, speaking of the Nifty, market momentum sustains as Nifty closed above the 25,300 mark in yesterday's trading session. Nifty Bank rallied for the 11th consecutive session led by PNB and SBI. Now, let's go across to Snehi, who's standing by to get us all the details from the market action roundup yesterday.
Well, yes, a very good day of trade coming in for the market, and that positivity that we've seen in the market continues because you had good moves coming in on the Nifty ending around 25,330. Slightly off the day's high, but close to that mark. So very positive move coming in on that front. Sensex too, a very healthy move is something that we've seen up about 0.3%. It was the Nifty Bank actually that outperformed the breadth of the market. 0.6% uptick coming in, led by SBI as well as Kotak Mahindra Bank. Watch out for some other sectors that were in focus today. We'll get to that, but let's talk about the broader end of the market because the mid cap was slightly subdued, but the small cap index continued to dominate the kind of gains that we've seen across the breadth of the market. Other than that, let's talk about some sectoral gainers and losers. It was the day of the PSU banks, Bank of Maharashtra, Indian Bank, Canara Bank, all of them doing pretty well. You had all the sectors in the green barring FMCG that was on the flat line, and you had some pressure coming in on metals. So metals about 0.5% lower. It was particularly the steel stocks, so Jindal Steel, Tata Steel, JSW Steel and the other stocks, Nalco, Hindalco, Vedanta, all of these stocks are under pressure. Anywhere between 0.5 and 1.5% of cuts is something that we have seen. Some other stocks in news then, Tata Consumer, one of the top Nifty gainers. You had the word coming in from the management that they are going to be passing on the benefits of the GST cut on tea and coffee from Q3 onwards. So on the back of that, Tata Consumer was a stock that did very well. Other than that, ABFRL on the back of their Gen Z launch did pretty well. KNR Constructions was one of the volume buzzers as well. And shipbuilding stocks, the likes of Garden Reach, Cochin Shipyard, Malco Dock, all of them did pretty well and refound the strength that they had lost in the past couple of trading sessions. They found that back once again. So that was the roundup of the market, and well, all eyes are going to be on the Sensex expiry on Thursday.
All right, we also have the Sensex expiry today, so that is something that we will be watching out for. It could lead to a volatile session, but as of now, we're seeing a start of almost 0.3% or 88 points higher. But let's get you all the stocks that you need to watch out for in today's trading session. For that, we are joined by my colleague Shrishti, who's joining us with all the stocks and news. Shrishti, take it away.
Well, yes, firstly, let's talk about Dixon Technologies. This stock is going to be in focus today on the back of a positive news flow as the company will acquire 51% stake in Kunshan Q Tech Microelectronic India worth 553 odd crores. That's indeed positive because the target company is a manufacturer of camera as well as fingerprints modules for mobile handsets, IoT devices and automotive applications as well. So Dixon Technologies will be in focus, but other than that, do watch out for Biocon as well because positive announcement coming in. They have got approval for 2 drugs. Firstly is Bosaya, which is used in the treatment of osteoporosis, and the other one is also used in the treatment for orthopedic. The drug name is Okelso. And US FDA has approved both of these drugs, and indeed a positive news flow coming in for Biocon as well. Along with that, Cohance Life Sciences will be in focus as well because there's a block deal that is likely when the seller could be Justmiral Holding with a 5.1% of equities to be sold at a 7% discount, that is at 900 rupees a piece. Along with that, Yes Bank too will be in focus because just yesterday we had seen so many announcements coming in with respect to SBI, SMBC, and today we get to understand that it's Bandhan Bank that has sold almost 15.4 crore shares of Yes Bank to SMBC at 21.5 rupees a piece, and so is Federal Bank, which has sold almost 16.6 crore shares. Along with that, Bajaj Finserv has come out with their 2029 target. Indeed positive because the company is expecting its total income to increase by 20 to 22%, reaching 3 lakh crores. Concurrently, its profit is projected to grow to 18 to 22%, hitting 20,000 crores, and the company is also aiming to significantly expand its customer base and anticipating a 15 to 17% rise to 20 crores customers by 2029. So these are the stocks that are going to be in focus today. Back to you.
All right, thanks Rishti for taking us through all those stocks that are likely to buzz in today's trading session. But which are some of the other stocks that are going to be in action? Ashesha, over to you. Which are the stocks that you are tracking today?
Well, yes, let's start with the defense sector, a sector that has been in focus for the last several trading sessions, and Cochin Shipyard in particular, and this is on the back of an order win. In fact, the company informed the exchanges that they've signed a contract with ONGC for dry dock and major layup repairs of one of its jack-up rig, and the order value stands at about 200 crores. So on the back of this order win, keep an eye out in Cochin Shipyard today. Meanwhile, Railtel, this is another counter which will be in focus on the back of order wins. They've received 106 crore worth of orders from Bihar Education Project Council, and remember, Railtel has won several orders over the last few trading sessions, and the trajectory continues today as well. Marico, meanwhile, there were several reports which suggested that Income Tax Department visited company's offices, and the company has now given a clarification to the exchanges that yes, officials of Income Tax Department visited company's offices and manufacturing sites in India. The proceedings are currently underway. Company is extending its full support to the Income Tax Department, but there is no material impact on the operations of the company. So important clarification that has come in. Marico will also be in focus on the back of this. Indo Solar, meanwhile, which is Wari Energies, being the promoter of the company, has sold about 15% of the paid up share capital of the company, and this is to comply with the minimum shareholding requirements of SEBI. So on the back of this, some shareholding changes have happened over here. TVS Motor, meanwhile, on the back of a new launch, where the company says that they've launched TVS King Deluxe Plus CNG 3-wheeler, and this launch has happened in Tanzania. So on the back of this expansion that has come through, keep an eye out on TVS Motor as well.
Right, so those are the stocks that you need to keep on your radar before the start of trading session today. But with that, it's time for us to slip into a short break. More news and updates on the other side. Stay tuned.
Onboarding of customers and intermediaries will be done in coming few months. As reported that Bima Sugam is likely to be Amazon of insurance for buying of insurance, for claim servicing, and for all type of insurance needs will be done through this Bima Sugam platform, is launched by IRDA Chairman Ajay Seth. The event was also attended by other CEOs also in first official meeting between insurance company CEO and insurance regulator IRDA Chief Ajay Seth. The website of Bima Sugam platform has been launched, and in this Bima Sugam platform, it's a company formed and it's regulated by insurance regulator IRDA, and all insurance companies has contributed for the Bima Sugam platform.
All right, moving on then, a day after high-level talks between India and US trade teams, Commerce Minister Piyush Goyal said that he is confident that the issues will be ironed out very soon. Let's listen in.
पहली बात तो ये युद्ध नहीं है, एक परिस्थिति है, अंग्रेजी में इसको सिचुएशन बोलते हैं, एक परिस्थिति है, उसके समाधान के लिए हमारी कई दिनों से, कई महीनों से बातचीत चल रही है, और आपने देखा होगा कि यूएस के प्रतिनिधि दिल्ली में थे, पूरे दिन भर बैठक चली, बातचीत चालू है, मुझे लगता है भारत और यूनाइटेड स्टेट्स मित्र देश हैं, हमारे दोनों नेता मित्र हैं और आगे चल के हर एक परिस्थिति का समाधान होगा. As far as the exports are concerned, I have consistently said that India's exports are growing every year, and this year also I expect exports to grow. And currently we're at a growth of about 6% or so in the current year compared to the corresponding 5 months of last year. I'm very confident that we'll end the year with a positive note. At the same time, dialogue is going on with the United States, with the European Union, with New Zealand, with Chile, with Peru, with Oman, several countries. Many other countries want to start the discussion for free trade agreement. So it's an ongoing process. India's growing strength and the fact that we will be growing in the Amrit Kal from a $4 trillion economy to a $30 trillion plus dollar economy clearly shows that India is the place to do business. India has immense potential and the world would like to work closer with India. With the EU also we had very good discussions in the last round. Their Agriculture Commissioner and Trade Commissioner, 2 ministers had come down to Delhi and the discussions have made very rapid progress. We may do another virtual round or we could do a physical round. All possibilities are open. Both leaders, Ms. Ursula von der Leyen, the EU President, and Prime Minister Narendra Modi have guided us to complete the negotiations before the year end. Trade, industry, अलग-अलग उद्योग और व्यापार संगठन और क्षेत्र के लोगों ने सरकार को आश्वस्त किया है. हम रोज इश्तिहार भी देखते हैं पेपर में कि इसका पूरा लाभ जीएसटी कटौती का जनता को पास ऑन किया जाएगा. चीजें सस्ती होंगी, उपभोक्ता के हाथ में और ताकत आएगी. उपभोक्ता अपनी रोजमर्रा की जरूरतों को सस्ते दरों पे ले पाएगा और कोई चीज छोड़ी नहीं है. खाने पीने का सामान हो, चाहे सुबह टूथब्रश टूथपेस्ट लगे, तेल बाल का तेल हो, कॉस्मेटिक्स हो, कपड़े, जूते, पेन, चश्मा, अब जो चीज सोचे.
All right, so those are the latest comments that we're tracking from Commerce Minister Piyush Goyal. But moving on, the recent GST rate rationalization will help to boost consumer sentiment, which will play big on India's auto sector. Yes, that's the word coming from Nitish Mangal, who's the auto and metal analyst at Jefferies. He also adds that entry-level affordability is also eased for consumers. Let's go across and listen in to what else he had to say about the sector.
Autos were actually very positive on consumption. We think this GST the cut is coming as a big boost to affordability. Also, the timing is very opportune just around the festive season. And then this is also happening after almost an year and a half of fairly subdued demand.
True.
So this, in our view, should bring a very big boost to demand. When I think of different segments of demand, let's say entry versus mid and maybe premium, across two-wheelers and passenger vehicles. While yes, affordability improvement helps the entry level a lot, but we also believe that people who are maybe earlier going to buy an entry-level vehicle will now have the capacity to buy maybe a mid-sized car or a motorcycle. So we think that the demand boost that comes is going to be across the different segments. And that can be very specific, let's say a 350cc plus motorcycle, which is not specifically seeing a GST increase. But other than some very specific segments, we think this is a very broad-based demand boost and not just at the entry level.
You're looking at from an up-trading perspective, right? In the sense, if the kind of boost that a person gets is from 70 to 90,000 rupees per car, and that could give him additional leeway to look maybe a model higher or a upgrade higher to a higher level. Is that what you're looking at, and it's not going to change the entry level dynamics?
No, so what I meant was there is going to be a demand boost across the categories.
Yeah.
So at an entry level, so for someone who was finding it difficult to afford a vehicle earlier, right, it becomes a lot more easier for him to afford. So we're not saying entry level will not get a boost. Entry level should definitely get a boost, but that demand boost is not limited to the entry level, because someone who was earlier going to buy, let's say, an entry level vehicle, now will have the capability to buy something better. So the demand, the entire curve of demand gets lifted upwards rather than just in one single category.
From an earnings point of view, how do you see that panning out for FY26 and 27? You almost have 2 quarters, which is almost like a slow, sluggish growth coming in. A boost coming through consumption, maybe Q3, Q4 onwards, which will be there. You see FY27 to be the big year in terms of numbers, volumes?
Yeah, so we do think second half FY26 and that flowing into FY27 through FY28 should be very strong for volume growth and earning growth for most of the companies. So across most of the OEMs, we are thinking anywhere between 10 to 15, 16% 3-year volume CAGR, and that translating into, let's say, 12, 13 to a 25% kind of an earnings CAGR over the next 2 to 3 years.
Two-wheelers, it's been sluggish for a couple of years now. I don't think we have crossed the pre-COVID numbers in two-wheelers. What's happening there? Do you see electrification of two-wheelers, cannibalizing the growth for the category there?
So we'll talk about electrification, but let's say we think of total two-wheeler demand, including EVs.
Yeah.
Right? Even that is still below where we were in FY19, which was the pre-COVID.
Yeah.
What has happened in two-wheelers is that we have gone through one of the most draconian phase of vehicle price increases, because we had a combination of various regulatory as well as commodity cost push that has made vehicles very expensive especially over 2020 to 2022 period. So we had this 3-year period where demand went down by almost 35%. We started to see that demand coming back now. So across different categories of autos, we're actually most positive on volume growth in two-wheelers over the next 2 to 3 years, because there is not just a boost that is coming from, let's say, a GST cut or an income tax cut, but there's also a lower base on which this industry can grow.
Yeah.
So we think two-wheelers will grow the fastest over the next 3 years, followed by tractors and passenger vehicles, followed by trucks.
If you look at some of the numbers there, many of the companies which are coming out with the wholesale numbers, a large part of the growth is driven by the exports rather than domestic consumption, which is there. Do you see that reversing? Last 1 year, we've been seeing month on month how exports have been contributing a significant portion to the growth. Do you see with urban consumption coming back after GST cut, that trend reversing?
So the gap should definitely narrow. So exports also went through a phase of a down cycle, and then they started to recover over the last year or so on that lower base. And yes, as you rightly said, we have in most of the recent period, exports have done better than domestic in terms of the volume growth. So we do see domestic volume growth coming back as well. And at some stage, exports growth will also get more normalized because the base will catch up. But yes, that spread should narrow. And in our view, both the domestic as well as export should see a fairly healthy somewhere between 10, 12, 13% kind of a volume CAGR.
Nitij, let me pivot from autos to 2 thematic research reports that you came in with. The first one is semiconductors. And, you told me that, at some point in time you were designing at NVIDIA as well in your career. How do you see semiconductor phase in India, the growth cycle? We're talking about how the US companies are looking at investing nearly $350 billion in capex in AI and other stuff. In India, we are just in a nation's stage. $18 billion is what the figures that you've written about. How do you see that investment happening in India?
See, India, the whole semiconductor and electronics industry is at a very early stage of inflection in our view. There are multiple tailwinds that are coming together. There is already a very large and rising domestic demand. And on top of that, the government policies have been very favorable to kickstart the sector. So they started with the PLI, and we started to do a lot of assembly of mobile phones in India. And then the government was very prudent in following that up with a specific semiconductor incentive plan, and then electronics component scheme as well. So now, in fact, we are at a phase where we can start to move from assembly into higher value add like chips and components.